Welcome back to F.A.C.E. David. How are you?
I'm well, Dale. Thanks for having me back. Good to see you.
It's great to have you. Just for people who don't know you, and Joe Perry said you're one of his favorites. Okay, so Joe, and David is Chief Market Strategist at StockCharts.com, President at Sierra Alpha Research, and also has his own website, marketmisbehavior.com. Oh, come on, David. The markets never misbehave. In fact, I wanted to ask you, for me, trading this pandemic has been even a little bit more challenging than the
Dale,
last one.
why don't we get him to share his screen first?
Yeah. So you look for the, David, you just look for the green button. It's coming up now.
Perfect.
Beautiful. Okay.
You see it okay?
Yeah. Okay.
Perfect.
We got it. So, David, last time we talked was before the virus popped, was a pin to pop the bubble, one of the most dramatic declines that I've seen in my trading career. And the big question is, after this decline, do you think that we bottomed and now we're just going to correct the correction? Or could a full-blown retest, like people like Gunlet are talking about, could that happen? Where's your head at?
So, what we have to remember, I know so many have talked about how this sell-off and the subsequent rally has been unprecedented. And by most measures, that's absolutely right. What we have seen plenty of times historically is a dramatic sell-off, and having a market lose 30%. We've just never seen it really this quickly coming off of a new all-time high. And then we've seen V-bottoms before. We've seen markets come very strong out of a depressed point. We've just never seen it happen this quickly and turn this quickly out of the lows. And again, we've seen the price movements, just not the time compression that I think we're seeing. So to your point, Dale, I think in many ways, the time factor of what we're seeing here is what's very unprecedented. What is pretty classic is the bear market evolution, which is a big sell-off from in a seemingly, a precipice that it feels like we're never going to come down from, that we come down suddenly. That has happened many times before. And a subsequent rally that retraces about 50 to 61.8% of that move. That's actually pretty classic. And if you look back through historical bear markets, that's kind of what they tend to look like. And we call this and what I would label this as a bear market rally. This is a rally that sucks so many investors in. And the really, fortunate investors are the ones that bought here in, the last week in March or first week in April. And then everyone else are the people that have sort of caught in later and are fueled by that fear of missing out of it, returning to S&P 3,400 or something like that.
Right. And I saw charts, David, that when we were up there before this recent sell-off, that growth was back at all-time highs. Growth stocks were back at all-time highs. So, people talking about valuations with what's going to happen on the PE made sense. I see a lot of gaps. I know you're a technician. And some people are talking about during this correction that we could get down towards that 25.5 gap. You think that is viable? Or, the question is, are we just going to correct the correction and then surpass 61.8, or are we looking at this as the end of the bear market rally, as you were saying, and new lows are coming? And how deep could it be if that's the case?
So I would say this, my short answer is I think we're going lower. I think, hitting 61.8% makes a lot of sense from a technical perspective. We've now retested it. The S&P's put in a bit of a lower high there in the last couple of days. And for me, when you're thinking about the tactical time frame, it's all about the peaks and valleys. And we've now, set a lower high. We are very close to setting a lower low. We have to go a little bit below 2,800 today, and that sort of satisfies the short-term downtrend. The other reason why I don't think we're going to go much higher than this is if you look at the RSI, it's peaked out right around 60, almost exactly at 60 the last week in April. And in a bull market phase, the whole range of momentum kind of bumps up. So when the market pulls back, it pulls back to around 40 or so, and then it'll become overbought on the upswings. On a downswing, the RSI will become oversold, and it'll never really get above 60. So the whole range has bumped down a little bit. So that is what gives me a lot of confidence that I think we're at I think we've hit the ceiling, at least for the foreseeable future. The other chart I would maybe show you to validate that is the cumulative advanced decline lines. And I'm sorry for jumping around with the charts, but
That's okay.
hopefully you can see this. So this is looking at the S&P 500, and then I'm looking at the cumulative advanced decline lines for the S&P 500, the New York Stock Exchange, the mid-cap index, the small-cap index. If you look, all four of those have been in this nice short-term uptrend, higher highs, higher lows. Everything's fine. This is coming out of the March lows. All four of them now, as of yesterday, have now broken down through trendline support. So we have this rotation. They've now put in lower highs. They're now putting in a lower low. And so even though the S&P hasn't broken down yet, breadth has actually broken down for a lot of these. And I think that's because people have gone to the safe havens of mega cap stocks, Microsoft, Amazon type of names that will keep the S&P elevated while the average stock has already started to rotate down a little bit.
So tactically, David, how do you take advantage of a bear market? I mean, a lot of people haven't even seen one that came into this business. You and I have seen a couple. It was a joke that I was here for the last pandemic, but really, a lot of people came in after '08, after the '08 lows, or they weren't here for the dot-com bubble. They've seen, every pullback since then just be a great buying opportunity. How do people learn to tactically take advantage of a bear market? What are you telling people? Is it just capital preservation, or is it an opportunity to play the downside for you?
It's such a great question. And I think you hit on a perfect point, Dale, which is the beauty of the infrequency of bear markets, but the regular nature of them is that every 5 to 10 years there's another one that gets a whole new group of investors that have never experienced one to sort of experience one firsthand. And so how do you play something like this with potential downside? To me, I think it depends on how long your runway is. So if you think about it, if you're in a retirement account and you're planning for the next 20 to 30 years, I would argue the market comes down, it's going to be the buying opportunity of your lifetime to be buying stocks as they're super depressed relative to where they've been not too long ago. If your runway is short and you're trying to play this more tactically, I think you have to be watching the tactical trends that I was pointing out, so the short-term fluctuations and looking at breakdowns of some of these key levels, which I think we're just starting to see the beginning of. And then I think, what do you do in terms of capital preservation? I think you're right. I think everyone has some equity allocation usually. So the question is, where can you park money within stocks? And so it's usually looking for income, looking for high yielding places, utilities, real estate, some staples, for example, which are scary because the price is going down, and you're right. But what you need to do is focus on the relative strength. And so for me, you're looking at stocks that have been able to weather uptrends and downtrends. Microsoft is one that comes to mind.
Yeah.
Even as the market rallied, Microsoft started to outperform as the market sold off into mid-March. The relative strength continued to go up. As the market recovered, it's continued to go up. So a lot of things in tech, if you look at the chart of the XLK, it's sort of a similar picture. It is outperformed in bull phases and bear phases. So I think you want to be in places that are outperforming, and so focus on the relative strength line, maybe more than you normally would, to find stocks that are able to outperform. And then you focus on the income component. Look for stocks, and especially in this environment where companies have been cutting dividends, look for like the dividend aristocrat type of names that have demonstrated their ability to keep a dividend through a lot of different previous cycles, previous downturns, and bet on that consistency, which is going to give you a consistent income above any other sort of product at this point, to be honest with you, relative to interest rates and elsewhere.
What's your view on taking positions in bearish ETFs, and especially the 2-3 times ones that I know there is erosion in those instruments where, say, for example, the underlying index may not make a new low, but they do because of the costs of the fund. Yeah. So I've seen that type of, it's almost like decay. Do you have a view on trading this stuff and having a piece of your portfolio? And is there a way in this rally, say people are long-term, in their IRA, for them to hedge for what could be another wave to the downside?
Yeah, that's a really good question. I'm glad you asked that. And so I think that's one of the really interesting, when you talk about what makes this sell-off, makes this bear market experience a little different. And in each one of the last bear markets you mentioned, the tech bubble, the financial crisis, there were some structural differences that caused it to be unique. And I think the one now is you have a lot of ETFs, especially those leveraged ETFs that have not been battle tested in a bear market environment. They haven't been tested with the amount of flows we're likely seeing, with structurally what happens if a commodity goes below zero. What does that do to an ETF that's plugged off of it? Like we can
like
figure
USO?
out theoretically what's going to happen, but that's a new experience for investors holding it, and that's what I think is going to impact people. With something like I'm bringing up the SDS here, and to your point, the SDS went from it went up from low 20s to mid 40s, and this was a huge 80+% gain, very, very quickly over a 4-week period. It's retraced 100% of its way back down to zero, even though the S&P only retraced 61.8% of that.
Yeah, so
sell-off,
that's very big decay.
What you have to remember is, anything that's leveraged, it's based on the daily percent moves, and so you think you're making an inverse bet to the market, but you're not exactly doing that. You're doing that on one day. But once you string a couple days together, you're becoming more and more disconnected from the actual trend of the market. So I think you have to be really careful about holding these for the long term, which they really weren't intended to do. You still could. And I think if you think the market's going to crater from here, buying the SDS, I think you could make an argument for it. I think overall you'll probably do okay with that. But just remember the exposure. I think a lot of people just need to be very familiar with what exposure you're actually getting.
I made that mistake, David. I admit it. I did it with TVIX and lived through reverse splits into oblivion. So, that's why I bring it up. A lot of people think, just like I thought, that I'm just making an inverse bet, and then they're wondering why they're not performing or underperforming the underlying asset. So, definitely know what you're doing before you click your mouse.
That's exactly right. And that's where I think, honestly, everyone viewing, I'm sure, is in tune with charts to some degree because they're using your platform and they're familiar with it. But I think this is where charts can have a great advantage. Don't just think, all right, I'm getting a double short S&P exposure. Great. Look at the chart and see what's actually happened over time, and look at what the performance has been, and understand. You start to make assumptions about if XYZ happens in the markets, what is that going to do to this product? And just make sure. And I think the same thing with costs. There are a lot of costs baked into a lot of these products that people are not aware of, in terms of the spreads on some of the ETFs that are wider than you would get in a stock, which are essentially zero now. So look at liquidity, look at your ability to get in and out of things, and just look at the exposure you're getting.
David, a lot of people through the previous two crises, most investment advisors or brokers at major firms had a formula: certain percentage stocks, certain percentage bonds, certain percentage cash. After what happened to the bond market when it got locked up, and say TLT traded 180 and now it broke to 140, does that put into question the fact that the bonds may or may not have the same type of benefit of being a hedge during market declines? Because if the Fed had not stepped into the corporate bond market, people were not able to finance it all. And do you think that the Fed has solved this credit crisis with these unusual steps?
And again, I think the future is going to tell us whether or not it's working. And I think that's the thing that's difficult about this environment. It's certainly the uncertainty of how some of these steps are going to actually work out are unknown. I think the unintended consequences is what we don't know yet, and that's what's going to come out later. In general, though, I think a lot of people make the mistake of making a simple comparison. If stocks are going down, I should go to a safe haven like bonds or gold or something like that. And for every time you show me where stocks go down and gold goes up, I will show you another time where stocks and gold go down together, where stocks and gold go up together. Because you have to remember, it's not like there are two securities, stocks and bonds, and people allocate to one or the other. It's not a zero-sum game. There are a lot of influences. As you mentioned, the Fed can create a lot of artificial supply and demand to change the picture. And as a result, I think, again, a focus on the charts is what can be really, really helpful, because you can understand what's actually happening. You had mentioned, I think, this round trip with the TLT, and
I've never, I've been doing this for a while. I mean, even going back to the Volcker days where you had rates spiking to the upside. I've never seen what's supposed to be a conservative market have that kind of range within a week.
Yes. Yeah, this is a new one. And I think there you could see this disconnection from reality that felt like a lot of things happened in mid-March. And, arguably that sort of corrected. And again, I think going back to your early questions about the market direction, I think what concerns me about this is, it's not just the Fed's actions that cause the prices to do a certain thing. I would argue that is relatively minimal. It's people's expectations of what the Fed actions are actually going to be able to do. And the reason why the market can recover so quickly is because they believe that the Fed can step in and buy high yield ETFs and do whatever they need to buoy the markets as they want, and they have the ability to move prices up. But what happens if the Fed continues to take that action and every investor on earth stops believing that they have the ability to do it? Even with that Fed buying, the market's going to start going down because the panic that's going to come from investors not believing it, the disbelief, is going to outweigh anything that the Fed can do for a sustained period of time. So I think the what we're betting on right now is that people will assume the Fed can come in and provide support and make markets do a certain thing. Once we, as a collective group of investors, don't believe that as much, I think that's when the market can go down in a meaningful way again, and maybe create the next leg down. It's that disbelief that's going to do it. But I would point out with bonds, the other thing is I would caution everyone. We often, one of the phrases I've always loved to say, don't confuse the bottom of the page with support. So when the 10-year yields are going down and you say, all right, well, they've gone down X percent, they can't go much lower than that. A lot of people were saying that all along the way back here. Yeah. And I know when yields broke below the low in 2016, a lot of people were saying, all right, well, the market can't go down much more. I mean, yields can't go down much more than that. And surprise, they actually can go a lot further down, and they can even go below zero, right, theoretically. And so I think just because something hasn't happened before or happened recently doesn't mean it can't happen. And so bond prices can certainly go higher from here. At some point, yields get so low, it starts to seem unreasonable, but it can happen. So again, I focus a lot on the trends and what the charts are telling me. And if the stock, trend starts rolling over, and if the TLT finds support at its 50-day, I could justify owning the TLT and not owning stocks and feeling pretty comfortable with that for a little while, for sure.
Okay, so what I've noticed, if you look at LQD and junk that with the Fed in it, David, actually they've outperformed sovereigns. So could it be there's junk, maybe junk isn't, but the LQD almost made new highs. I'm wondering if what the Fed is doing to prop up the private sector is at the expense of sovereigns. And also, politics can play a role. And I'm wondering what your thoughts may be when President Trump talked about canceling debt with China on the bonds and, deteriorating. I know people that say we're already in a Cold War. It sure wouldn't take much, just a little bit of selling by the Chinese to cause a panic in the bond market, don't you think?
That's absolutely right. And I think that's where I think the uncertainty is the artificial buying and selling that can come in. When we're looking at sort of the, bear market playbook and historical market downturns, there has always been, again, there have always been some sort of structural events that have been part of it, right? So the 87 crash, portfolio insurance caused all sorts of issues. And with the financial crisis, the things that have been put in place afterwards have changed the structure of the market enough that we don't know what a bear market exactly is going to look like. But we do know that human behavior is universal, and people's ability to, be optimistic or pessimistic with their investments is what's really going to cause things to move. Having said that, we're in this period where you can have news headlines and expectations change so quickly with dramatic impact on the markets. And I think that's what we've seen over the last couple months now. Dramatic sell-offs that are met with dramatic rallies and volatility in the bond market that we've not seen really ever since I've been following since I've been following things. And so,
Okay.
I think, could that happen? Could bond prices go down dramatically? Absolutely. I think where investors get into trouble is where they start to bake in the probability of something like that happening and then use that as the way to position themselves, because it's such an unknown. I think what you should do is think about, all right, there's this potential that this event could happen, which would most likely cause bond prices to go down. Look at the charts. At what point would bond prices hit? What would they hit? What would the TLT or the LQD or whatever hit? At what point I need to just cut out of it?
Or am I wrong?
The trend is down. Yeah, and it doesn't matter.
You have to know that before you go in. You don't go in and then try and find people that'll rationalize your position.
Yes.
Don't you think that most of your best strategies are laid out on the kitchen table over the weekend before market activity even begins, so that you can execute rather than analyze on the fly?
That's exactly right. And I've taught technical analysis and behavioral finance at the college level. And what I would always tell my students is, you have earned once you answer these questions about the chart, Dow theory, moving averages, all these things, you have now earned the right to tell me whether or not you would buy or sell, or whether you're bullish or bearish. But the way you earn the right to actually take a position is you tell me what your exit strategy is, and you lay it out right ahead of time. I'm buying here. This is where I was wrong, and I get out. And so I think if you have that in place, I think the future is very uncertain right now. The market direction is uncertain, but that shouldn't bother you as an investor if you already have your plan laid out. When this XYZ happens, I'm going to take this action. If you can automate that as much as possible, do it. And then you're not, because otherwise you're making an emotional reaction, as you hit on. You're doing confirmation bias, which is, I'm bearish, and now I'm going to try to find as much information as possible to validate that bearish thesis, which is not the way to make money over the long term.
I had a college professor. I wish it would have been you, but the question was, David, what's worse, ignorance or apathy? And my answer was, I don't know, and I don't care. So I aced it. So I want to get to one more asset class. We have time for it, David. Are you a believer in this gold mining breakout to the upside?
I mean, gold, if you look at the chart of gold, I mean, overall, if you're looking at different asset classes and looking for something that's set up in a pretty positive configuration with, I think, potential for a lot further upside, gold, I'd be hard pressed to find one better than gold, to be honest with you. Okay. Even given all of this volatility, even given all of the uncertainty, the GLD has pretty consistently outperformed with periods of underperformance, but overall the relative strength seems to just keep continuing. There are very few asset classes that are going higher above 2 upward sloping moving averages. Gold is doing it. We have a ranking of all of the different stock universes. So we have a ranking called the Scooter ranking of all the large cap stocks from 99th to 1st percentile based on their trend profile. Newmont Mining has been pretty consistently one of the top 1 or 2 or 3 names for the last couple months, with good reason. I mean, it's consistently demonstrated higher highs and higher lows at a time when most stocks have not, and it's continued to outperform. And the outperformance has been pretty fantastic. It's outperformed the S&P by almost 75-80% year to date, which isn't bad. That's not bad for equities.
Let me ask you this, though, David. I have noticed that, or I was reading that flows into GLD are at record levels. Assets under management are at record levels. Is that any kind of sign that it might be getting crowded?
So that's the concern, right? I mean, and I think you're right. One of the challenges with commodity ETFs, or one of the maybe untested parts of them, is what happens when flows are extreme, inflows and or outflows, and what happens to them. Still, I think there is for especially institutional investors, there is an apathy, if you will, for gold. And I, with my time at Fidelity, would talk to the portfolio managers about owning gold in their portfolios, and they would say they could never go to an institutional client and justify owning gold in an equity portfolio. They just can't do it. So a lot of funds won't ever go there, and as a result, I feel like there's opportunity to for that to be a much further upside, even though there's been plenty of flows in there already. And I think it goes back to when something becomes overbought, and the chart of gold is actually a great example of that. people tend to think when something's overbought, when there have been extreme inflows, extreme demand, or lack of supply, that's a bad thing. Overbought is bad. But in the chart of gold, you can see overbought conditions, especially extremely overbought conditions, when the RSI gets above 80, that actually ends up overall being a good thing, because there's such extreme momentum, there's such buying interest that it's probably going to have further upside. Where you start to get concerned is when the price keeps going up and all of a sudden the momentum wanes, right? When
well, look to the right-hand side of your chart. Isn't that what's happening right here?
So what's different now is that prices are actually coming down, which is what's interesting, right? So if you look here, you've had, yes, from the March peak to the April peak, you have this potential divergence with the RSI in February and the lower RSI in April. If that's what you're talking about, I think you're right. And I think that's the one danger side on my view of gold, is this one big divergence on the weekly chart. It probably jumps out even further. But again, what invalidates that is the price making new highs. So the GLD closing above 163, sort of getting to a new closing high, sort of pushes.
Yeah, I think it's going to happen. It's knocking on the door, buddy. You know, I'd like to ask you a question, one host to another, and you know that you host different interviews on stockcharts.com, and I happen to have noticed something. I get the weekly email, and I recommend other people get the email and check out stockcharts.com. But, you know, don't you feel the same way as me, that what an advantage to be like today, me having a chance to pick your brain as part of intelligence gathering? Because I did see a piece on stockcharts.com near the end of March by someone from my generation. I don't know, you're not as old as me, David, but Larry Williams saying, I'm buying stocks here. And that was right near the low. So do you, with your position and overseeing all the different, and you guys have some of the masters are contributors to stockcharts.com, doesn't that make you a better investor, trader, having the ability to gather intelligence from other people that you respect in the industry?
I mean, I would hope it's a great advantage. And I think your ability to talk about this, current environment and bringing all of your experience to bear of previous bearish cycles that you've been in, I think is fantastic. And, what I've always coached newer investors to do is learn as much from people that have come before you, because as much as the market is different structurally, there are so many consistent themes, because the human behavior element is consistent. And even though structures are different, the way we make bets are different, human behavior is universal and consistent. And the fear that motivates investors is consistent. So talking with guys like John Murphy and Martin King and Larry Williams, and asking them questions about what did this feel like? And even, again, from my time at Fidelity, asking Peter Lynch and Bruce Johnstone, what did 1974 feel like? And how did you, Walter Deemer comes to mind, who ran the technical team at Putnam in the 1970s. What was the 1974 low like? How did that feel? What was the, how nervous were people at the bottom? What did the 83 breakout when the Dow finally broke 1,000? What was that like? And so I think the as much as you can ask questions of people that have been through some of these pivotal moments, I think is fantastic. And, again, it's great to learn your own lessons by putting your own capital at risk. And there's no substitute for that. And every great investor I've met has had a story of climactic loss from earlier in their career. And that's a formative lesson for them. But I always remind newer investors, learn lessons from others where it's not your capital loss first, and try to gain what you can from them, and equip yourself to minimize the pain from some of those early lessons. And that's how you're going to, become a better investor for the long term. But I think you're right. I think we're very fortunate to be able to tap the brains of you and many others.
And you just did that today here, David, for 30 minutes, edifying our community here in F.A.C.E. and sharing your views. So the best way for people to follow you and stay in touch with you, your Twitter handle at DKellerCMT, is that correct?
That's absolutely right. And on stockcharts.com, I host the daily closing bell show on Stock Charts TV called the Final Bar. So check it out. You
TV star, you. Thank you so much, my trading warrior brother, David Keller. Cheers. Everybody.
Cheers, Dale. Be well. Thanks again.
All right, buddy. Thank you, David Keller. And that's a wrap for us. We'll see everyone tomorrow. Remember, don't just count your pips, count your blessings. You're welcome. David, if you're still here, you're getting some great comments. Someone said, I can't be here for the full interview, but I know it's an excellent presentation. I want to watch a video later. So much appreciation from the audience today. Thank you, David. And adios, everybody.